Yeah, well, corporate bonds offer you a very great level of diversification. If you think about corporate bond market, you have different kind of sectors, different kind of companies, different sort of maturities to choose from different countries. So you can diversify how many levels you want. And also, I mean, if you think about yields that you are getting in corporate bonds, regardless of the credit fundamentals, you are getting more than you get in the government bond market. So whereas in the government bond market you have to go up to 5 years in maturity to actually get to positive returns, within the investment grade market, or broadly speaking the corporate bond market, you are able to get, even with the short maturities, very attractive positive returns. Yeah, well, of course, if rates get up, it's going to affect all the funds that are investing in the corporate bonds. But at the same time, it is good to have, for example, high yield exposure in the fund, because high yield market is not driven by the rate movement. The correlation actually to the rates is quite low, comparing to, for example, investment grade, which is driven mainly by the rates and in some part sentiment. High yield market is driven by the sentiment, and same applies in some parts to the unrated bonds. So, I mean, if the rates get up, it's good to have high yield if the sentiment is also staying good. Yeah, well, I would say that think again, because if you look past history, high yield has produced more returns than European equity market, for example, for the last 10 years several times. So it's definitely a market where you can have a good and meaningful returns, but at the same time, as a part of portfolio, it's giving you very stable return and kind of like lowers the volatility if you choose your investments wisely. Within the corporate bond market, you can find very high yielding bonds with a very high risk, but you can also find very low risky, high credit fundamental corporate bonds that gives you very stable return. And as part of the portfolio, it is very good to have this sort of sub-portfolio of corporate bonds. Basically the same that has been around for the last 24 months. So you have political risk, which is of course now very acute in Europe, and you have new government in Italy, populist government, shaking the boat a little bit. Then you have trade war discussions with the US against the rest of the world. You have central bank policy, so there's a lot of things that might get wrong, but at the same time it's very comfortable that the European economy is doing so well. So at the moment it feels that the economy hasn't been that strong for the last maybe 10 years, so it can take a lot of realized risk to actually change the market direction.